Now, last week we covered Chapter 10, and I told you that Chapter 10 will only be focusing on the first half of the chapter, pretty much just the short-term notes payable and also other current liabilities. So for Chapter 10, you just have to review the first part of Chapter 10. Whatever I covered last week, that will be it. Okay, regarding human resource, the payroll, you can just skip that section. Okay, I'm going to come back to that if we have time, but if not, I'm going to skip it for final. Now we're moving on to Chapter 11, still on the chapter content of liabilities. Okay, liabilities are basically, again, debt that the company raised, either from the public, from other companies. Today we're talking about the liabilities, the debt, meaning the money that the company borrowed from others that has a lifetime for longer than a year. Okay, Chapter 10, we have been talking about liabilities that has a lifetime shorter than a year, a couple of months, half a year. Okay, Chapter 11, we're moving on to different types of liabilities that has a longer lifetime. So specifically, we'll be going over journal transactions for long-term notes, for mortgage payables, and then a pretty heavy part of this chapter is on bonds. Okay, so we have long-term notes, mortgage payables, and bonds. There are various different situations on how to journalize bonds transactions. What are different cases? Breaks down to 3 main cases. Okay, so again, the focus for each and every chapter, you have to know what are the new journal entries, new accounts, debit credit side, how is it represented on statements. Okay, for each and every chapter, this is always the core. What are the new accounts, new journal entries, how is it represented on statements? Let's take a look at the first section here, journal transactions for long-term notes payable. We've actually talked a little bit about this in Chapter 10. Remember the part that we talked about on current portion of long-term notes payable? That's basically the part of long-term notes that will be due immediately next year. Okay, so this was an exact example we covered last week, last Wednesday. If there's a long-term note that your company signed off that worth, you borrowed money, $20,000, say 2013, May 1st. And you borrow this money, sign off on notes, note certificate. Basically, this note has a lifetime for 4 years. So sometimes these notes will be paid by installments, meaning that we're not just paying off the money altogether 4 years from now, but we're breaking it into little portions, $5,000 as time goes by. Okay, so the first year, at the end of the first year, you'll be paying a part, 1/4 of the $20,000, $5,000 after the first year, another $5,000 after the second year, another $5,000 after the third year, and then the very last year also the additional $5,000. Okay, so this $5,000 that immediately will be due the following year, in a sense, it's not a long-term notes payable because it only has a lifetime of 1 year. Okay, so that part, if this note, the characteristic of this notes payable is paid by installments, a certain amount equal every single year, then the part that will be due immediately next year, we reclassify it into current portion of long-term notes payable. Okay, so meaning this is actually a short-term liability account. So there's $20,000 here, and then immediately we reclassify a part into short-term notes payable. So both of the T accounts will look like this. So this happens May 1st. You first borrow the money, and then you reclassify it into current portion of long-term notes payable. Okay, so this is not saying that your liability reduces $5,000. We're just separating the part into the part that will immediately be due next year, and the part that will be due the second year, the third year, and the fourth year. Right? So this part is a review. We covered this in Chapter 10, just the reclassification part. And where we're continuing on this journal entry is after the first year, or at year end, what do we do with this notes payable? So remember, for each and every note, what does it come together with? Interest, right? So for each and every note, as long as it's called notes payable, the difference between notes and accounts payable is that there's definitely interest accumulated along with this principal amount that you borrowed from others. Okay, so this note is signed off May 1st. What would happen December 31st? It would accrue interest, and specifically for how many months? May to December 31st, and if we count the number of months, that will be 7 or 8 or 9. Should be 8, right? Because we're just missing January, February, March, April, right? So 12 months minus 4. We start from May 1st. May 1st is the beginning of this month, so the entire May counts. December 31st also counts, so altogether there's 8 months of interest. So tell me, how do we calculate interest here? Do we calculate interest based on 5,000 or 20,000? 20 because that's the principal amount, right? Currently, there's still $20,000 that's due, so by the end of this year, it will be $20,000 times the interest rate, it's given 6%, times 8 over 12. So at the end of the year, if we want to accrue interest, what do we debit? Just like short-term notes, what do we debit? Come on, interest. We want to accrue interest at the end of the year, which means your company borrowed money, so you owe other parties interest. How do we recognize this? Interest expense, very good. It's the debit side. What about credit? Interest payable. The reason why it's payable is because whatever this dollar amount is, the interest amount, the reason why it's payable is because this note is not due, not even the part that will be due a year. The part that will be due a year will be due next year's May 1st. But when it reaches the end of the year, what we're trying to do is just recognize how much interest has been accumulated on this note. Okay, so this is not paying cash yet. We're paying cash later on after a year. Remember, a short portion will be due. $5,000 is due here, plus interest is also due for that year. Okay, so a little portion of the note will be paid off, and also a little portion of interest will be paid off. So if you have this in mind, then when it reaches May 1st, second year, 2014, what happens is, remember, we're paying a portion, $5,000, and we're also paying a whole year of interest, which would add up to 800 was from last year end, 400 is from this year's January, February, March, and April. Okay, so when it reaches next year, remember, part of this long-term notes will be due at this point. $5,000 is due, listed here. And then together with this $5,000 will be a year of interest. The reason why we're breaking the interest into 400 and 800 is because this part is accumulated last year end. This part is from this year, beginning of this year. Consider this year's interest expense. Okay, so this is an entry May 1st, 2014. So 2014, this $15,000 here, we reduce an additional $5,000. After this entry, notes payable would have a balance, long-term notes $10,000, representing the third year and the fourth year. And this current portion still stays here. Okay. Special part of this long-term notes, if it's paid by installment, is that the current portion of long-term notes payable, we don't do this reclassification entry every single year. We only do it once in the beginning. Remember, when we sign off the note, we immediately classify this into current. This stays here to represent every single year's current portion. We reduce this when it gets to the fourth year, meaning the last year. Okay, which is why you see this journal entry a year later. We should have debit current portion of long-term notes, right? Because earlier we reclassify it. But keep in mind that this note has a lifetime longer than a year. So if we debit current portion, we need to do that reclassification entry again for this year. And then if we debit current portion, we have to reclassify it again. So instead of doing that, we just reclassify it once. This will just stay here to represent each and every year's current portion. So when we pay off the note, we would just debit the long-term notes payable. Okay, so meaning that the very last year when it reaches this point, the entry would look like interest expense, interest payable, current portion of long-term notes. This happens the fourth year, the very last year of any problems, long-term notes payable. Very last year you'll be debiting, reducing current portion, and then this part becomes 0. But this only happens the very last year of each and every problem. Okay, so once again, for each and every long-term notes, this basically represents that your company is borrowing money from others or could be purchasing items from other companies, signing off a long-term notes payable, agreeing to pay principal amount plus interest later on. And instead of paying it all together at the end of the due date, sometimes some of the long-term notes are broken down by installments. So companies will be paying little portion of principal plus little portion of interest every single year. So the first, if a notes payable is this type, paid by installments, then first entry when we sign off the note, immediately we reclassify the part that will be due next year into current portion of long-term notes. So first, when the note is incepted, always there's 2 entries to this. A regular notes inception entry and a reclassification entry. Now when it reaches year end, we always do interest accrual. Okay, this part you have to have it in the back of your mind. Every time for notes, short-term notes, long-term notes, if it carries on to the following accounting period, when it reaches December 31st, we always do an interest accrual entry. Okay, now when it reaches the due date for the part of installments, a year later, 2014, this is what the entry would look like. Okay, you're paying off actually the part, $5,000, and you're paying a year of interest, altogether $6,200. Okay, $5,000 belongs to the installment principal amount. Interest to part is accrued last year. Part of the interest was accumulated this year. Now here's a question for you. First year end, when we accumulated interest, we used the entire principal amount. What would happen if it's this year's end, after paying a portion, when it reaches 2014, December 31st? How do we calculate interest for this? Well, if it's May 1st, we have this entry, so we will still calculate from May 1st all the way to December 31st. So it would actually still be 8 months if we count the months. But what about here? We paid off $5,000, which means earlier we borrowed $20,000. A year later, you paid off $5,000. You no longer have that money now. You paid it off. So what's left? $15,000. Okay, so this year end, 2014, when we do this interest accrual entry, it would not be $800 anymore. It would be a dollar amount less than $800. $15,000 times still a yearly interest rate times 8/12, the lifetime. Okay? So this is the first year's accrual interest. This is the second year's. And the third year's interest, again, since we paid off additional $5,000, third year at year end, we'll be using 10,000 times 6% times 8/12. Okay, because we paid off little by little principal amount as time goes by. Okay, so besides this, everything else pretty much is the same. When it reaches year end, you do this interest accrual entry, just how you get the dollar amount. Keep in mind that we no longer owe $20,000 anymore because remember first year end we paid off $5,000. So we just owe $15,000. So you accumulate interest based on $15,000. When it reaches third year end, you did another entry that looks like this. So you reduce another $5,000. So you have 10,000 times 6% times 8 over 12. Okay, following year again you have the remaining 5,000. Then the following year you have 0. Okay, so this will be the last. So whenever it reaches May 1st, 2015, you will still have this entry: interest expense, interest payable, long-term notes, cash. When it reaches the very last year, the only difference is that current portion, the part that we reclassified, will be debited in the very last year. Okay, now these are the journal entries part. Let's take a look at how it looks like in T accounts. So the same problem, if we represent it under T accounts, this entry is exactly the same as the previous slide. Remember the 400, 800, 5,000, 6,200. So you see we opened up 3 T accounts here. First one, right-hand side, long-term notes. This is the time point when we borrowed money, $20,000, the first year, remember, in the beginning. What happens immediately is we reclassify a part into a current portion of long-term notes, just like how I wrote over there on the whiteboard. This is exactly the same thing. So this $5,000 would stay there until the very last year. That's the time we debit it. Otherwise, in the middle part of the years, it just represents the part that is due the following year. Okay, so after this reclassification, long-term notes here, $10,000 represents the third year and the fourth year's debt. Then installments, payments, when it comes to a year later when we're paying off $5,000 and we're paying off also $800 of interest. Okay, and then don't forget we have another account, interest expense, that has the $400. So the red part of the numbers creates that first journal entry, the upper journal entry. Any questions to this? Okay, let's work on a problem together. On January 1st, 2014, this company signed a $200,000 5-year note that has a 6% interest to it. At this loan, the company decides to make payments together with the company they borrow money from. They're making payments to them $40,000 principal amount plus interest, so on a yearly basis. Okay, so try to journalize the issuance transaction and then the reclassification transaction in the first sub-question here. Second, if we want to do a first year's payment, part of the installment payment, how would you journalize this? I want to see everybody working on the problem. Okay, I'm going to ask, what's the answers to this? Okay, first entry, how do we journalize this? Issuance entry and classification entry. What do we debit credit here? Cash we're receiving, right? And then credits, long-term notes payable, right? Reclassification for what dollar amount here? So we reclassify a part that worth 40,000, right? Because every single year we're paying $40,000. So reclassification part represents every single year's current portion of long-term notes. Okay, so there's two entry in the beginning, January 1st, 2014. First is the issuance entry, issuing long-term notes, and then collecting cash you borrowed, $200,000. Okay, but this dollar amount, we're not paying it all together 5 years from now. We're paying a portion every single year, portion that worth $40,000. So after this issuance entry, we immediately reclassify the part of long-term notes into current portion. Okay, so they still belong to long-term, still belong to liability category, just different types. So current portion of long-term notes, this is a short-term part that will be due every single year, $40,000. Now the last question in this problem asks you to journalize first note payment. So first note payment, since this is a note that signs off January 1st, first note payment, how will we journalize this a year later? So meaning that, is this a note that carries on to the following accounting period? Usually that's the one that's signed off somewhere in the middle of the year. Okay, so what happens at the end is that we are paying off the part of the principal, $40,000, and at the same time we're also paying off the interest, $12,000. Okay, so left-hand side we have interest expense, long-term notes payable, and there's also cash. Okay, these two debit account, cash we're paying $52,000 because a part is $40,000 is principal and then $12,000 is interest accumulated for a year. Okay, we're not accounting for how many months because this is a note that's signed off in the beginning, January. So when it reaches all the way to year end, it's pretty much a year. Okay, some problems may ask you to journalize a payoff entry January 1st. Some problems may be December 31st, so that depends. But usually when we do this interest accrual entry, it will definitely be a note that's signed off somewhere in the middle of the year. Okay, but if it's signed off in the beginning, January 1st, and a part of it is immediately due a year later, sometimes the payment altogether will be made at the end of the year or just the beginning of the following year. Okay, but the point is that we'll no longer be accruing interest for this case if a note is signed off beginning. Okay, because it pretty much doesn't carry on to next year in the middle of next year. It's just immediately due a year later. So this same entry here would happen again December 31st, 2015. But what would be different? Well, the debit account would still be the same, credit account would still be the same. So what's the difference? Compare this journal entry to the future entry, 2015, December 31st. Dollar amount is specifically which account? For interest expense, we would use, instead of $200,000, it would be minus $40,000. Because remember, we paid off $40,000 in the first year. This journal entry here, we paid off $40,000, so the following year when we accumulate interest, it will be only $160,000 times a year interest. Okay, when it reaches 2016, it will be $120,000 times 6% interest. Okay, so on and so forth. So don't forget to reduce the principal amount along the years. When you pay off long-term notes, that part you basically don't accumulate interest on it anymore later on because you paid it off. You don't owe it anymore. Okay, this is the first category of long-term liability. Now we're moving on to mortgages, mortgage payable. Okay, mortgages payable is another type of long-term liability. The difference is that these type of liability typically happens if a company wants to purchase long-term assets, specifically property type of asset, land, building. Oftentimes they sign a contract on mortgage payable agreeing that if later on for some reason they're not able to pay back the fund on time, usually mortgages are paid every single month, a fixed amount every single month. For some reason they're not able to pay the money on time, the other party who signed the contract with you has the right to transfer the assets titled to them. Okay, if my company purchased a building and land together, a group purchase, sign a mortgage payable, I would pay incremental, little by little, of principal and interest every single month. But if there's 1 month that I'm not able to pay the money, and if it basically passes the grace period, then the other party has the right to transfer the title of my building and land to them. Okay, so it's backed up by assets. This type of debt is backed up by assets, security interest in specific property. So legal title of the specific asset will transfer if the mortgage is not paid on time. They have the right to do so. So this is different from short-term notes and long-term notes. Usually those type of liabilities are not backed up by assets. Okay, so if we compare this to long-term notes, again, mortgages is backed up by property. Long-term notes payable doesn't have this characteristic. They do have similarities in the sense of the current portion part. So mortgages, whenever we sign it off, we also estimate in the following year what is the part that will be paid off. And we also reclassify a part of mortgage payable into current portion of mortgage payable. Okay, so this relationship here is similar to long-term notes payable. They do a reclassification of the part that will be due next year. Mortgage payable, we do the same thing. Okay, we sign off a dollar amount, and then we reclassify a part into short term, into the current portion of mortgage payable. Okay, so we're going to take a look at a table, how it actually works. Mortgage is a little bit more complicated because the fixed amount that we paid on a monthly basis breaks down to a part that we're paying by principal, a part that we're paying by interest. And it's not a fixed amount like how we calculate long-term notes payable. Long-term notes, we just use the principal full times the yearly interest rate times the month. This part is easy to understand for long-term notes. The principal amount in full, later on you reduce perhaps $40,000. For mortgage, the structure is a little different from short-term and long-term notes. Okay, the principal amount is constantly changing on a monthly basis. Okay, so again, keep in mind mortgage payments usually are done on a monthly basis and it's a fixed amount. But mortgage payment, that fixed amount on a monthly basis breaks down to principal payment and interest payment. But what is the amount for principal and what is the amount for interest? Every single month is a little different. But this part is a fixed dollar amount of payment. What goes into this, what goes into this is a little different on a monthly basis. Okay, so the table we're going to show in the next slide is called amortization schedule. The amortization schedule basically is similar to the idea of depreciation. We're spreading along mortgage along each and every month, and then also on a yearly basis. So it shows that which part of mortgage payable is being paid, which part of interest expense is being paid. All right, let's take a look at an example here. The upper title shows amortization schedule 2013. We'll just read the first box here. If we not look at the amortization for a minute. First box, it tells you the problem here. December 31st, 2012, Smart Touch Company purchases land and building by paying cash and signing 30-year mortgage for $100,075. Just up to this point, can you tell me how to journalize this entry? Purchase entry. If we're purchasing items, assets, so what do we debit here? We'll be debiting building, remember chapter 9, and land. And what about credit? We're paying a part cash, a part of it by cash, usually down payment, and then the other part will be the new account in this chapter, mortgage payable. And it tells you the dollar amount, right? Cash we're paying part $49,000, about $49,000, and the other part about $100,000 we're paying by mortgage, meaning this is a liability. We're not paying immediately. This is the part that we're paying immediately. Okay, so whatever this dollar amount is, the left-hand side should equal the right-hand side. This is what the journal entry would look like. So this part will go into, remember in chapter 9, group purchase. We talked about relative assets weight. At that time, lump sum purchase, this will be how we determine the left side. Okay, but in this chapter, we'll be focusing on how to deal with mortgage payable here. Okay, so this right-hand side here, mortgage payable, this is the part that we're trying to get to, how to account for this. How do we spread this along months, along years? How do we pay it off? That part, the liability. This entire table is dealing with this. Okay, now, it tells you that we agree on a monthly basis. Usually the problem will tell you what is the mortgage amount. They would also tell you on a monthly basis what is the fixed amount of payment. In this case, it's $600. Okay, this in reality is also set up front. So the portion of mortgage on a monthly basis that if you purchase a house or home or a different property, each and every month the payment for mortgage is the same. It's a fixed amount. Okay, so this dollar amount will be given to you in problems. Just take it as given. What we need to do is determine what part are we paying as principal amount, what part are we paying as interest amount. Okay, so the middle two column is the part that we're trying to determine here. Right-hand side, mortgage dollar amount will be given to you. Left-hand side column, $600 fixed amount, you will also know this information. Now we need to calculate what part is interest that you're paying, what part is principal. So we break down that $600 into $500.38 and $99. Okay, so we get to interest expense by using the green box over there. The full mortgage payment times the interest rate given to you, 6%, times just 1 month over 12. Okay, again, mortgage is paid on a monthly basis, so interest is only accumulated for 1 month. Okay, now the pink box over there, principal amount. Principal amount, you simply get it from after you get interest, subtract that from 600. That will give you principal amount that you're paying. Okay, first we start from mortgage balance, $100,075. Fixed amount is given to you on a monthly basis, you will be paying $600. So to calculate interest expense accumulated on this mortgage balance for the first month, we use the full amount of mortgage payment, $100,075 times yearly interest rate times 1 month. Because up to now, we're just dealing with January 31st, 2013. Okay, so once you figure out the interest portion, remember fixed amount breaks down to interest portion and principal portion. Fixed amount in this case is $600. Interest portion, you got it from calculating it in the green box, $500.38. Then the remaining is principal amount, 62. Okay, so this is the first month. Now, after the first month, if we just stop right here, after the first month, if we want to transfer this into a journal entry type, Because remember, first month, what we're doing here is calculating the amounts that we're paying $600, what part belongs to principal, what part belongs to interest. If we want to journalize this, credit side would be cash, because we're paying off $600. This part we definitely know for sure. Every single month is always $600. The part that belongs to interest expense would be $500.38. And the part that we're paying as mortgage payable would be $99.62. Together forms this $600 of fixed payment. Okay, so principal amount we're paying, we just get this from after calculating interest, subtract it from fixed amount. And then it goes into this journal entry. This is the first month of payment. Credit cash 600. These two parts breaks down to 600 into interest payment, principal payment. Principal is referring to the original mortgage amount. Okay, so if we're paying off about $100 of original mortgage amount, after the first month, your original mortgage amount will be reduced to about $99,975. And then that will be the new base to calculate the second month's interest expense. Again, the green box, but now keep in mind the first number has changed because we paid off a little bit of mortgage payable. This is the part that we paid off. So you reduce it for the following month. So that reduced part will give you $499.88. So how do we get the principal payment for second month? The payment minus interest, 600 minus $499.88 will give you the second month's pink box. Exactly. Okay, so second month's dollar amount will not be this anymore. Even though the cash part is still credit $600, this is the part that will remain the same always for each and every month. Interest expense, account name is the same, mortgage payable is the same, but the dollar amount is different. So for the second month, it will be $499.38, and then principal amount will be $112. This will be the second month's journal entry. Okay, so after this, again, $600 breaks down to principal and interest. So the principal part, we're paying off an additional $100, mortgage balance reduced to $99,875. The part that you borrowed is gradually reducing as you pay off a little bit of principal every single month. So then the following year will follow the same structure. Following year, you will reduce it to calculate an interest expense by another green box that has a different amount. So you will be replacing the $99,975 with $99,875. Okay, so that goes on and on. But just keep in mind, cash part is always $600. The cash payment that you're paying is always credit $600. The part that we're doing with this table is to determine which part belongs to interest, which part belongs to principal payment. Now the blue box showed here amount to be reclassified to a current liability. Keep in mind that this entire table is just for 1 year. Okay, 1 year breaks down to 12 months. So your first month of payment looks like this, second month of payment, so on and so forth. When it reaches the last month, altogether this is the total mortgage payable that you paid off in an entire year. And this table we usually calculate it up front when we start the mortgage payable contract. We calculate this amortization schedule up front. This reclassification entry happens as soon as we sign off the mortgage payable. Okay, that entire table is there to help you understand on a monthly basis how do we pay the mortgage, what part is interest, what part is principal. But don't forget that the entire year's payment, in the first entry we immediately reclassify the part to current portion on mortgage payable. as soon as purchase, building, and land entry happens. Okay, so just like long-term notes payable, we sign off long-term notes, borrow the money, reclassify it. For mortgage, we sign off, create this journal entry, and immediately reclassify the part that will be due in an entire year into current portion. Okay, and again, this dollar amount, you can get it from this entire table here, principal amount. Now the bottom entry here, I actually already showed you earlier. Bottom entry here shows you a month later after borrowing money, how do you journalize the entry with that table. So a month later, you pay cash $600. Remember how we got to the first month interest expense, use the full mortgage payment. Second principal amount will be subtracted. Subtract this from that, it will give you principal amount that you're paying. Okay, this is after the first month. Second month would look like this. Okay, let me go back to that table again. I'm going to guide you through this once again. This is a little bit more complicated than notes. You're going to right-hand side, the total amount, the first line is the total amount that you borrowed, mortgage payable balance. Fixed amount will be given to you, $600 will be paid on a monthly basis. We need to calculate interest expense and principal amount, meaning we break down that $600 into a part that you're paying that really belongs to mortgage balance, a part that is accumulated based on the amount that you borrow, interest. So we calculate interest based on the full, first month would always be based on the full mortgage balance times interest rate times time period, a month over 12. Principal amount would just be whatever is left over, the difference between $600 and interest expense. Okay, then after this first month, you have a reduced principal balance because you paid off a portion, $99.62. So your reduced mortgage balance will be used for interest calculation for the second month, which is why the green box, the first number is different, because you have a new balance. So in a sense, this is a little bit similar to double declining depreciation. Remember, the book value becomes the following month's base to calculate in times 2 over 5 or 2 over 6. Now the new balance for mortgage payable, the money that you still owe, becomes the base to calculate interest. Okay, so then you have the new interest expense. You see a gradually decrease because mortgage balance is reducing. Okay, and then principal amount will be again the difference, $100. So interest expense along the years will gradually be reducing because you're paying off little by little of mortgage on a monthly basis. So interest will definitely be accumulated based on a smaller portion as time goes by. The principal amount that you're paying off will be increasing as time goes by. And then these green numbers, pink numbers becomes the journal entry for this one. Okay, this is the green part, this is the pink part. All right, I'm going to move on to bonds. I'm going to come back to this problem when we have time. Describe bonds payable as another type of long-term liability. So far we talked about long-term notes payable. We talked about mortgage payable. It's backed up by assets. If the borrower doesn't pay back the money, then the creditor has the right to legally have the title of the assets. Bonds payable is another type of long-term liability. It's like groups, it's sort of like groups of long-term notes, except that it's more structured in a way. Usually bond certificates are issued by companies and typically on a specific value for each bond certificate. Usually it's by $1,000 by a unit. Meaning each bond certificate may state $1,000 and their interest rate that they want to offer to creditor. Then they issue it out. Whether or not they can get that $1,000 depends on the market's status at that moment. Okay, so later on we'll go into, in case that the company is offering an interest rate that is different from what the market is expecting, how will we deal with those issues? The three different types. Okay, sometimes the interest rate matches, meaning if the company wants to borrow money, they're offering creditor a certain portion of interest rate, let's say 6%. If the market also has a 6% anticipation, if it matches, then it's great. They want to issue $1,000 and they can borrow $1,000 from the market. In case that interest rate doesn't match, sometimes company doesn't have enough fund, they're only able to give out 5% of interest rate. But if the creditor, the market is expecting a higher interest rate, then basically your company's bond is not as attractive. So you may not be able to entirely borrow the $1,000. Perhaps you'll only be able to borrow $980 or $970. If we flip the case, sometimes if your company is doing pretty well, you're able to offer an interest rate that's even higher than what the market is expecting, then your bond certificate is more attractive to the market. You'll be able to borrow more money than what's stated on the bond certificate. So this is another way to increase the fund for company to operate their activities, to have additional fund other than what they raise from stock. They can also raise money from issuing bond. Okay, but the difference is that if you issue bond, whoever that holds it is not a stockholder, but a creditor. Okay, because they basically borrow money to your company, they need to get it back from you later, and you also will be paying interest. If it's stock, it's another issue. Okay, stock will be covering this in chapter 12 and 13, but try not to confuse the two. Okay, this is a way to borrow money. Stock is a way to raise capital, and you don't have to pay back or pay interest to it. But bond is just like a regular type of liability, except that it's more structured. Okay, $1,000 a unit bond certificate will be determining what is the actual amount that the company is actually able to receive at the time they issue it. May not necessarily be $1,000. Depends on how the market's interest rate is compared to your company's interest rate that's willing to offer to creditor. Okay, so basically the purpose, again, is for large companies to require large amount of money from the public to finance operations, borrow money from the public. They issue bond certificate. This is a source document, evidence of this loan. Loan means the debts that you raise from public, the money that you borrow. So on the bond certificate would state definitely the amount, the maturity date, when is the bond due. So just like short-term notes, long-term notes, it has a due date, and also interest rate that your company is offering to creditor. Okay, bondholders receive interest, and another difference between this and short-term and the long-term notes is that bondholders, creditors, usually receive interest semi-annually. Half a year later after they borrow money, they receive a portion of interest. Half a year later, they receive a portion of interest. So this is kind of the fixed rule for bond. Okay, you borrow money to the company raises money from you, you get the interest rate half a year later, every half a year, semi-annually. Okay, now the principal amount is usually not paid like long-term notes on an installment basis, not paid incrementally little by little every single year. It's usually paid back the very last year. Okay, so interest rate is breakdown twice a year for sure. Principal amount, usually for most of the cases, is paid off at the end of the year. For most of the problems you see in this chapter, it will be paid off at the end of the year. Okay, meaning that we don't break it down into different years, little by little. Company will be paying off this to creditors all together, but interest will be paying little by little. Now, another terminology difference is that maturity value. We've learned this in short-term notes and long-term notes. So what does it mean, maturity value? Principal amount plus interest, exactly. Now, in the bond section here, maturity value always refers to the original face value of the bond. Okay, under bond, this section here, maturity value equals face value equals par value. You may see these terms interchangeable in the book. Maturity value of the bond, par value of the bond, face value of the bond. That's everything you see on the face of the bond. Okay, later when we go into, yes?
Face value includes the interest?
Doesn't include the interest. Okay, so maturity value for bonds specifically does not incorporate interest. For short-term notes, long-term notes, maturity value is principal plus interest together, right, when it's due. That's how you calculate it in Chapter 10. Or up to now, for long-term notes, it's at the same time. But for bond, whenever we say when bond matures, the maturity value of bond is always not including interest, just the face value of it, $100,000. So it's like the idea of your original principal amount. Okay, so later when we talk about an example, if the company raises bond $1,000, regardless of what's the dollar amount they actually receive, maturity value is $1,000. If a company raises bond, issues bond $100,000, the face value is $100,000 you see in the problem, or it tells you the par value is $100,000, maturity value is $100,000. Okay, so this maturity value would always be the money that a company pays back to a creditor. Sometimes, even if they don't actually borrow, they didn't actually borrow $100,000, they later still have to pay the maturity value, the face value, the par value. Okay, so these three terms are interchangeable. You just have to keep it in your mind. I'm just going to quickly go over the different types of bonds. You don't have to memorize this. This is just giving you a sense of there are different categories of bonds, different characteristics. These categories are actually not exclusive. So some of the bonds could be a term bond. Term bond basically just tells you that there's a same specific date for all the bonds that this particular company issues. So it just has a particular date for all the bonds that the company issues. Serial bonds, this sometimes happens, but in the problem you will not see these type of questions, breaks down by installments. But for most of the problems will be given by term bonds. Okay, but serial bonds also exist, so part of the bonds will be due every single year. Secured bonds, some of the money, the bond certificate while company issued to the public, if they don't pay back to the creditor on time, some part of the assets will be legally transferred to that creditor. So some of the bonds are also backed up by assets, very similar to the idea of mortgage. This is called secured bonds. Debentures, just the opposite of secured bonds. Most of the bonds are not really backed up by assets. So debentures are very popular too. Usually just basically means the opposite of that, not secured by any type of asset. So a not secured by any type of asset bond usually has an interest rate that is slightly higher than secured bonds. Okay, secured bonds is backed up by assets, but at the same time it's since it's less risky, so the interest rate usually is also lower for these bonds. Okay, so this is just a general category. There's many more to this. It's not exclusive categories, just so you have a sense. There's different characteristics of bonds. Okay, so most of the bonds that we're dealing with in this chapter is considered term bonds, has a specific due date for these bonds, meaning the maturity value will be paid on the due date, not by installments. And most of them are debentures, not backed up by assets. So most of the problems you see in this chapter fall under the first and the last category. Okay, now bonds price here, bonds price, the issue price of the bond may not necessarily be the same as the maturity value, the face value, or par value of the bond. Okay, this is why in this chapter there's 3 different cases. We may be issuing bond at the maturity value. So now you know this maturity means just the face value of the bond. If the face value is 1,000, you issue it as 1,000, meaning if I'm the company, I'm collecting 1,000. This is issuing at maturity value. Issuing at a value the same as its face value, par value. Sometimes company will be issuing the bond at a discount. This usually happens if the interest rate that a company is willing to offer to the market is not as attractive, lower than what the market's interest rate is what's the anticipated market interest rate. So in this case, if a face value is 1,000, even though the company is issuing this bond, they may not be able to get cash that's worth 1,000. It may be something like 980. The difference here, the $20 difference, is what we call the discount on a bond. So this discount represents that the company is not able to get the face value of the bond, even though they're issuing this to the creditor, meaning later on they have to pay 1,000 back to them. But at this moment when they issue the bond, they're not actually borrowing $1,000. They are only able to borrow a dollar amount less than 1,000. This is called a discount on a bond. Okay, now issued at a premium is the opposite to discount. Issued at a premium, if the interest rate your company is able to offer to the public is, let's say, 8%, public is anticipating only 6% of interest. So obviously your company is offering something very attractive. Your bond, in terms of creditors, if they want to invest money, they're getting more back if they borrow money to your company compared to borrow to other companies. So in this case, companies often will be able to issue bonds at a premium. Okay, premium is at a dollar amount above $1,000. So it could be $1,200, $1,100. As long as it's above face value, it's called a premium on bonds. And the premium is referring to the differences between the dollar amount that company is actually able to borrow against the dollar amount stated on the face value of the bond, maturity value. Now, a very important concept to all these 3 situations, very important concept is that regardless of what's the dollar amount that the company is actually able to receive at the time point they borrow money, this part is always the same. What they return to the creditor later on is always the same. It should always be the face value of the bond, the maturity value of the bond. So in all 3 cases here, you see the issue price. Issue price equals the cash that a company is able to receive at the moment they borrow money from others. However, issue price may not necessarily be the same as maturity value. Issue price may not necessarily be the same as maturity value. It could be the same. That's the first case. They borrow money, $1,000. Bond certificate states $1,000. Second case, their interest rate is not as attractive, lower than the market, and they issue bond at a discount. They're not able to get 1,000. They only get about 980, 970, but later they still have to pay 1,000. Third case, they borrow more than $1,000. This is a premium. If your interest rate is higher than the market's interest rate. If it's a premium, later on again you are still paying back just $1,000 to creditor. Okay, but earlier you borrowed more. So regardless of these cases, at the end, whatever is on the bond certificate, that's the dollar amount at the end the company is paying back to the creditor. Okay, regardless of what they borrowed in the first place, they're always paying off maturity value, face value at the end. So this is why there's a note here. Issue price does not affect the required payment at maturity. So when the note is due, it's always the face value. Company must pay maturity value of the bond at the date stated on the bond and also the dollar amount stated on the bond. Right, so bond interest rates, stated interest rate on the left-hand side is what the company is able to offer. Right-hand side, market interest rate is what the market, basically creditors, are expecting. So I just mentioned the three different cases occurs because sometimes the interest rate do not agree with each other. They don't match, they're not the same. First case, ideally, if they want to borrow $1,000, interest rate that they offer is the same as what the creditor is expecting. And these, in terms of how interest rate changes, why is it not the same as market interest rate? Many of your finance courses, financial management courses, will go into these topics. Okay, so in this accounting course, we're just going to take these interest rate as given. What you need to do is just compare the interest rates. This is what the company is able to offer. This is what the market is expecting. So if the market is expecting more than what your company is able to offer, that basically means if other company is able to offer a bond that has 10% of interest, then the creditor could just simply purchase other companies' bond. So your company is at a disadvantage for issuing bond with a lower interest rate, which is why usually later you're not able to get what's stated there on bond certificate. So if we flip the situation, if market interest rate is lower than where your company is offering, your company's bond is more attractive. And so you're able to raise the money sometimes even above bond certificate stated value. You're able to borrow more. Okay, so this is issuing bond and maturity value if interest is the same. Lower than market, issue at a discount. Lower than face value. If the interest rate is higher, issue at a premium, higher than face value. Okay, so again, stated interest rate is what the company is offering while they issue the bond. Market interest rate is what the creditor is expecting. Okay, now bond prices usually is quoted as percentage. This part is simply just telling you that if you see bond prices stated as 100, that means 100% of bond certificate's value. So if the certificate value has $1,000, if your company is issuing it at 100, that basically means you're issuing it at exactly the bond certificate's price, 100% of this. Okay, bond prices usually is listed as percentages. So just like this, 100, 101.5, that means 101.5% of the face value, meaning you're issuing it at a premium. You get more. If it's 89.75, just think of those as having a percentage next to it. So it's 89% of the bond certificate's value. So you just times those two numbers to get what is the exact issue price that the company actually got from issuing the bond, borrowing money from others. Okay, so just a way to recognize bond prices. Usually it's listed as just 3 digits or 2 digits. Think of it as percentages. All right, let's go over a few simple examples here. It tells you that market bond prices depends on market interest rate, stated interest rate, time. In the following ABC situations, first case here, the market interest rate is 6%. The company is issuing bonds payable with a stated interest rate 5.75%. So what does this tell you? Is the company at an advantage or a disadvantage? Disadvantage because market interest is anticipating a higher interest rate. So if they really issue a bond, let's say $1,000 for each bond certificate, they're not able to get $1,000. They're getting a dollar amount lower than that. So it's a discount on the bond because their interest rate they're offering is only 5%, 5.75. Okay, what about the second case? Second case is the opposite as the first one, so it would be a premium because market rate is 7.25. Your company is able to offer interest rate 8%. So as a creditor's perspective, they will want to borrow money to a company that they can get more than, on average, what the industry, other company has. Okay, third case, 7% of the bond stated interest rate. Market is also 7%. So this is the easiest case. This basically is issuing at the maturity value, at the face value. So the bond is $1,000, you're getting $1,000. Your company is receiving $1,000. Okay, let me skip this for now. I'm going to move on to, just going to talk about the first case. Okay, so for maturity value of the bonds, if we're issuing the bond, this first entry here, just like a regular borrow money entry, except that we're switching short-term notes payable to bonds payable. Okay, earlier we're talking about long-term notes payable, mortgage payable. Once we issue a bond, let's say the dollar amount given to you is $100,000. You issue multiple bond certificates of 1,000. You issue 100 of these $1,000 bond certificates. Interest rate is 9%, and let's say assuming the market interest rate is also 9%. This 5-year bond, the first day when we issue it, we receive the cash from creditor. This is a journal entry that we journalize the issuance of bond at maturity value. The entry of the issuance only looks like this if the interest rate matches. 9% of stated interest rate equals market interest rate 9%. Okay, on Wednesday we'll cover the second and the third cases. First issuance entry will not look like this. Okay, so this is the first type, equal interest rates and market interest rate. Second entry here, half a year later. Remember that bonds, we usually pay interest half a year later, semi-annually. So half a year later, interest expense, just like how we calculate short-term notes, long-term notes interest, principal amount times interest rate times half a year. Okay, the time period is half a year because bonds interest is usually paid off half a year. So meaning that you'll have this journal entry June 30th, you will also have this journal entry December 31st, exactly the same. And this part here will not change because here we're not paying by installments. The full amount, $100,000, will be paid at the end when the bond matures 5 years later. So throughout the 5 years, every half a year, the journal entry will look exactly the same as this, okay, for the next 5 years. Because it's yes, it would always be 6 over 12, and this part, principal amount would always be this, $100,000, okay, for this case. Okay, so the third entry here, what happens when we paid off the bond, when we collect the, when the company pays off the bond to creditors. You want to guess how we journalize this? Well, since we paid all the interest half a year, so we got rid of the interest part. So we're just left with the maturity value. Okay, so the third entry, again, would always be whatever you borrowed, whatever is listed on the face value of the bond, maturity value of the bond. Okay, so there are 3 main entries to bonds. First, when we issue the bond, collect cash, credit bonds payable. Second, when we have interest expense accrued, interest expense paid off every half a year. This part is not accrued, it's actually paid off semi-annually. And then 5 years later, when it reaches 2018, we're just paying off the entire maturity value. So debit, liability, credit, cash. So there are 3 entries to this first case. When interest rate matches, first entry, last entry, we're just flipping it. Let's take a look at the first section here, journal transactions for long-term notes payable. We've actually talked a little bit about this in chapter 10. Remember the part that we talked about on current portion of long-term notes payable? That's basically the part of long-term notes that will be due immediately next year. Okay, so this was an exact example we covered last Wednesday. If there's a long-term note that your company signed off that you borrowed money, $20,000, say 2013, May 1st. And you borrow this money, sign off on notes, note certificate. Basically, this note has a lifetime for 4 years. So sometimes these notes will be paid by installments, meaning that we're not just paying off the money altogether 4 years from now, but we're breaking it into little portions, $5,000 as time goes by. Okay, so the first year, at the end of the first year, you'll be paying a part, 1/4 of the $20,000, $5,000 after the first year, another $5,000 after the second year, another $5,000 after the third year, and then the very last year also the additional $5,000. Okay, so this $5,000 that immediately will be due the following year, in a sense, it's not a long-term notes payable because it only has a lifetime of 1 year. Okay, so that part, if this note, the characteristic of this notes payable is paid by installments, a certain amount equal every single year, then the part that will be due immediately next year, we reclassify it into current portion of long-term notes payable. Okay, so meaning this is actually a short-term liability account. So there's $20,000. Now, last week we covered Chapter 10, and I told you that Chapter 10 will only be focusing on the first half of the chapter, pretty much just the short-term notes payable and also other current liabilities. So for Chapter 10, you just have to review the first part of Chapter 10. Whatever I covered last week, that will be it. Okay, regarding human resource, the payroll, you can just skip that section. Okay, I'm going to come back to that if we have time, but if not, I'm going to skip it for final. Now we're moving on to Chapter 11, still on the chapter content of liabilities. Okay, liabilities are basically, again, debt that the company raised, either from the public, from other companies. Today we're talking about the liabilities, the debt, meaning the money that the company borrowed from others that has a lifetime for longer than a year. Okay, Chapter 10, we have been talking about liabilities that has a lifetime shorter than a year, a couple of months, half a year. Okay, Chapter 11, we're moving on to different types of liabilities that has a longer lifetime. So specifically, we'll be going over journal transactions for long-term notes, for mortgage payables, and then a pretty heavy part of this chapter is on bonds. Okay, so we have long-term notes, mortgage payables, and bonds. There are various different situations on how to journalize bonds transactions. What are the different cases? Breaks down to 3 main cases. Okay, so again, the focus for each and every chapter, you have to know what are the new journal entries, new accounts, debit credit side, how is it represented on statements. Okay, for each and every chapter, this is always the core. What are the new accounts, new journal entries, how is it represented on statements? Do we calculate interest based on 5,000 or 20,000? 20 because that's the principal amount, right? Currently, there's still $20,000 that's due, so by the end of this year, it will be $20,000 times the interest rate, it's given 6%, times 8 over 12. So at the end of the year, if we want to accrue interest, what do we debit? Just like short-term notes, what do we debit? Come on, interest. If you want to accrue interest at the end of the year, which means your company borrowed money, so you owe other parties interest, how do we recognize this? Interest expense, very good. It's the debit side. What about credit? Interest payable. The reason why it's payable is because whatever this dollar amount is, the interest amount, the reason why it's payable is because this note is not due, not even the part that will be due a year. The part that will be due a year will be due next year's May 1st. But when it reaches the end of the year, what we're trying to do is just recognize how much interest has been accumulated on this note. Okay, so this is not paying cash yet. We're paying cash later on after a year. Remember, a short portion will be due. $5,000 is due here, plus interest is also due for that year. Okay, so a little portion of the note will be paid off, and also a little portion of interest will be paid off. So if you have this in mind, then when it reaches May 1st, second year, 2014, what happens is, remember, we're paying a portion, $5,000, and we're also paying a whole year of interest, which would add up to $800 was from last year end, $400 is from this year's January, February, March, and April. Okay, so when it reaches next year, remember, part of this long-term notes will be due at this point. $5,000 is due, listed here. And then together with this $5,000 will be a year of interest. The reason why we're breaking the interest into $400 and $800 is because this part is accumulated last year end. This part is from this year, beginning of this year. Consider this year's interest expense. Okay, so this is an entry May 1st, 2014. So 2014, this $15,000 here, we reduce an additional $5,000. After this entry, notes payable would have a balance, long-term notes $10,000, representing the third year and the fourth year. And this current portion still stays here. Okay. Special part of this long-term notes, if it's paid by installment, is that the current portion of long-term notes payable, we don't do this reclassification entry every single year. We only do it once in the beginning. Remember, when we sign off the note, we immediately classify this into current. This stays here to represent every single year's current portion. We reduce this when it gets to the fourth year, meaning the last year. Okay, which is why you see this journal entry a year later. We should have debit current portion of long-term notes, right? Because earlier we reclassify it. But keep in mind that this note has a lifetime longer than a year. So if we debit current portion, we need to do that reclassification entry. Dollars here, and then immediately we reclassify a part into short-term notes payable. So both of the T accounts will look like this. So this happens May 1st. You first borrow the money, and then you reclassify it into current portion of long-term notes payable. Okay, so this is not saying that your liability reduces $5,000. We're just separating the part into the part that will immediately be due next year and the part that will be due the second year, the third year, and the fourth year. Right? So this part is a review. We covered this in Chapter 10, just the reclassification part. And where we're continuing on this journal entry is after the first year, or at year end. What do we do with this notes payable? So remember, for each and every note, what does it come together with? Interest, right? So for each and every note, as long as it's called notes payable, the difference between notes and accounts payable is that there's definitely interest accumulated along with this principal amount that you borrowed from others. Okay, so this note is signed off May 1st. What would happen December 31st? It would accrue interest, and specifically for how many months? May to December 31st, and if we count the number of months, that will be 7 or 8 or 9. Should be 8, right? Because we're just missing January, February, March, April, right? So 12 months minus 4. We start from May 1st. May 1st is the beginning of this month, so the entire May counts. December 31st also counts, so altogether there's 8 months of interest. So tell me, how do we calculate interest here?